Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, January 13th, 2020. Again, not much to report. As I said recently, I'll cut back on the end-of-day market updates if there's not any new technically significant developments, such as, well, anything really. The trend is up, and it's been a resilient trend. So what we need to see are, some solid trend line breaks followed by impulsive selling, any type of reversal candlestick patterns. Again, when you're in an uptrend at new all-time highs, there's not any resistance levels overhead, or really much to point out, other than maybe once in a while you might get a bull flag consolidation pattern or some other type of consolidation pattern that might project another thrust up. But as of now, it's just been a by the pullbacks to support or pullbacks by the dips has been working, and then we still need to and haven't taken out that 211.42 level that was tested successfully a couple weeks ago. Even there in the after-hour session, or it was the after-hour session that night, not shown here on this daily chart. So what you can see as I zoom in tight, we have an uptrend line back test right there. Still have a divergent high on the 60-minute. They haven't taken that out yet. I'm surprised. It's been a strong, resilient trend. Today was a decent update too, better than 1% on QQQ. So what I've done here is added a secondary, what we call a benefit of the doubt trend line, and similar posture on SPY. I haven't even updated that chart. And what I mentioned I would do recently is I cut back when there's, when we are in just a steady grind higher without any changes to the technical posture of the market. I'll make a point to every now and then cover a couple trade ideas on the site that have been closed out. Right side of the chart, it's a freemium service, meaning a free general broad market analysis on the major equity stock markets. Some of that is reserved, some of that analysis is reserved, such as the morning post, the updates, midday updates, but the end of day stuff is public content. And then 90+% of what I post on the site and what I do personally as far as my trading and investing goes, those are the trade ideas. So individual stocks, sector ETFs, commodities, currencies, things such as Bitcoin, treasury bonds, you name it, anything other than the general stock market indexes. So we'll go ahead and take a look there and give you an example today of a good and a bad. We'll talk about the Beyond Meat trade. BYND, we hit our final target today. This is a trade we entered yesterday, less than 1 week ago, closed it out today for a 34% gain, hit our final target. That's right here at 104.26. We took it right here on the breakout. In fact, I can show you, here's a string of how those trades played out. There's the first chart that was posted back on, what is that date there? It was less than 1 week ago. It was last Tuesday, the 7th, and added it as an active trade at 78.07, stating that a breakout above this trend line and that resistance level looked imminent, and this stock was poised to run. So that's the good. We went through here. You can see each one. Very next day, we hit our first price target right there. 2 days after that, we went on to hit our second target. Then the day after that, we were coming up on our third target, and the charts were so constructive. I've traded this type of stock before. There's a lot that goes into this analysis, but based on not just the basis for the trade, but the follow-through price action, I went ahead and added a fourth target there before that third target was hit. Just for those of your subscribers, I'll never add a target after the fact. If the third target had been left alone as the final target, then it's going to do no good to add a target after that. So always in advance, and that's what we did there. So the following day, T3 was hit, third target was hit, and we raised the suggested stop on that, and then today final target was hit. So that was the good. Booked a 34% gain, 33.5% to be exact, and then turned around and also waited till it got a little higher and then tried a short trade. So that's the one we'll talk about. That. Oh, and before I forget, there is a couple things on back to the broad markets. I want to get on just some developments to monitor, something worth pointing out. Article touch on from CNBC today, and it dovetails on the comments that I've made recently, and I want to show you a couple charts, the percent of stocks trading above certain key EMAs or moving averages. But on that trade today, so the good was, the good takeaway so far this week was, that the long on Beyond Beyond Meat getting closed out for that 34% gain, and then added it as a short. And I, did state it's an aggressive short, highly counter trend. We hit our first target on what I viewed to be, and it still very well may prove to be. I already updated that in the notes. It may prove to be what I call a momentum-fueled overshoot. So the basis of that trade, we took it there at 107.40 with a very tight stop, which went on to being hit. It's just, the momentum was strong. We didn't get that reversal with the overshoot that I was looking at. But the takeaway from this is we were stopped out for a 2% loss. I think it was 2 point, whatever it was, 2.2, something like that. So that's the key is here you can take those shots, and on a counter trend trade, this tight, I kept this tight, a tight stop, a more aggressive stop than usual, just about a 2% stop versus the pullback targets. And the reason is, number one, it was highly counter trend trade. This thing's going vertical right now, parabolic. And again, sometimes I'll take those pot shots, but when doing so, when you have a stock that's running up, this thing at one point I looked, it was up over 15% today. You don't want to let your losers get too far away from you, because they can get away from you fast. Got to know the stocks are trading. And again, so that was the that trade was stopped out, and if nothing else, that's a lesson on maybe wait. Now I will say this: I thought about that. I often will wait for the sell signal. Sell signal would come in a reversal, and I made mention in the comments section as to why I went ahead, because quite often when these stocks hit my final price target, the reversal, especially when you have this parabolic move up or vertical run up, the reversal comes so sharp and swift. If you don't get in there quick, you're going to miss an entry. So I wanted to get the setup out to everybody in the trade idea. And again, so there was the takeaway from it overall. Yes, aggressive. The more higher probability entry, the more likely to play out would have been, and still will be, to wait to see a reversal and a fall back down below. In fact, let me show you the other chart. It was based largely off the daily chart too. This one was posted last, what was that, the 10th, I think, on Friday or so. As we were coming up there, and I showed some targets here, and coming up to the 105.41 resistance level there, and that's where I expected the reversal to come from today. And so the stock went beyond there, and again, may or may not pull back next week, or tomorrow, I should say. The week isn't over. You have these additional targets here. But again, if the only takeaway that I would give on this is, yes, if you're a conventional, more conservative trader, you wait for the reversal. In some cases, that means you may not get in, or at least have an objective entry, because objective entry has everything to do with the amount, the risk reward, how much you're looking for your pullback target. In other words, let me try to explain that. Let's just say tomorrow the stock gaps down to right here, and you're only targeting a quick pullback to that target there, about 97.86. That's not an objective entry, because your downside, your profit potential is minimal compared to any stop you would set. Now, maybe if you were shooting for this target, but again, it's all about risk reward, so that's why that trade had a tight stop, very tight stop, and a very attractive risk reward ratio, meaning that how much loss you're willing to take for the amount of gain you're looking at. And I always factor that in, and on a counter trend trade that has a higher probability of being stopped out, like this one, that's what made it an aggressive trade. I will balance out the lower probability of success will be balanced out with a higher risk reward ratio. In other words, you take 5 of those, you might be stopped out on 3, maybe even 4, but when you finally get one with a 5 or 10 to 1 or better risk reward ratio, it more than makes up for it. On regular trades, I like at least a 3 to 1 risk reward ratio, but on the lower probability trades, I like a higher risk reward ratio. So, all right, so that's that. And let's talk about one thing in the market to note. A couple things, actually. Let's get back to the markets here. Let's look at QQQ. I want to compare it to USO. I talked about this recently, this stark divergence. Let me pull this chart here, and let's go to an hourly chart so you can really see it. All right, so what you're looking at here, and this goes back quite a while. QQQ is in purple right there. USO is in white. And don't look at the difference in price, just look at the trend, how they move in lockstep, how the stock market has been moving in near unison with crude oil prices. And you can see in each corrects. Again, crude oil is more volatile. On a good day, it'll go up a lot more than the stock market on a good day. It can go up 5, sometimes even more than that, 8%. But 3 to 5 is a pretty good move, but not really unusual for crude oil. But anything much more than 3%, especially 5, is unusual for the stock market. So, and same thing on the downside. Crude can fall 5, sometimes even 10% in a day. So therefore, just look at the direction that each are heading, and you can see in the major inflection points too, the major turning points, tops and bottoms. You can see all that there. So here's what I wanted to point out: huge disparity between the stock market, and yes, I'm focused on QQQ because that is all the market is about. I'm going to head into that right now and talk about that. Segue into this article from CNBC today. The 5 biggest stocks are dwarfing the rest of the stock market at an unprecedented level. I encourage you to read this. It's something I've talked about recently. I've seen it, and again, this drives home that here's the key points: Apple, Microsoft, Alphabet, Amazon, and Facebook. Those 5 stocks collectively are what I refer to as the FANGs, FAAMG. That's my acronym, not the N, because Netflix is way down there. It doesn't have the weighting these guys do in the market. These guys make up 18% of the market cap of the S&P 500 and a much larger percent of the NASDAQ 100. And that is, we're getting to really nosebleed levels. It just money's been flowing into these. And the important thing too to note, you might say, well, they're great companies. Why shouldn't they be? Well, their income contribution to the broad market has decreased in recent years, so it's a red flag. And then there's a lot to this, and you can read through the article. But what happens? These are crowded trades. Everybody's piling on to these companies because they know them, they're comfortable with them. They are earnings juggernauts, but their earnings are also volatile, and stock prices are now really getting ahead of themselves. So again, take a look at that. Now, here's a chart. I wanted to show you these two right here. Let's save that change and center this chart right here. There it is. This is the NASDAQ 200, NAA 200R, which is the NASDAQ percent of stocks trading above their 200-day moving average. And so on the top, you have the NASDAQ composite. Let me center that chart for you so you can see a little bit better. There we go, right about there. All right, so up top, you have the NASDAQ composite, and down below you have the NASDAQ percent of stocks above their 200-day. This goes back for years here. Actually, well over a decade, all the way back to 2005. So what you can see here is leading up to the previous market top. It doesn't look like much because I cannot set this. Stock charts won't allow me to set the upper scale of the NASDAQ composite to log scaling. You should, in my opinion, never use a long-term 10, 20-year chart on something like the NASDAQ or any growth stock using linear scaling, which is non-log. It gives you a distorted picture because what it's doing, it's not showing you these moves in equal percentage terms. So it looks like the market's going parabolic here. But again, this was a 55% bear market right here, the Great Bear from 2007 to 2009 lows. And again, these drops don't look like much, but they were near 20% drops. And plain and simple, and again, I've showed this chart in the past, and I have not doctored it up to try to make the case here. What you're seeing is stark divergences between the stock market, especially the tech-heavy NASDAQ composite. You'll see a similar thing on the, if you look at the S&P 500. Stark divergences in price going higher and the percent of stocks trading above their 200-day moving average. So this right here shows you this drop-off from that last peak. These divergences have continued to build, just like the indicators that I've been covering on the broad markets, on the weekly and daily and even monthly charts. I'm talking about the PPO, the RSI, those momentum indicators. This divergence continues to build. And what happens? It builds and builds and builds until it finally plays out. Back here we had better than a 21% drop in the NASDAQ composite. That was last fall. Not last fall, the fall of 2018. And you can see from there, we still have the percent of stocks significantly lagging, well below their previous peak. So there's that divergence. And here's the thing, guys, it continues and it continues until it doesn't continue. It's as simple as that. But it typically the longer these divergences last, the bigger the divergences. I'm sorry, the bigger the correction. You know, these were small little divergences right here, and they were relatively small corrections. Bigger divergences, bigger corrections, so or bear markets. So keep that in mind, and you'll see the same thing on the percent of stocks trading above their 50-day moving average. And that is this chart here. So again, pretty much showing you the same thing. There's a big drop, NASDAQ up top, all the other corrections, same thing. You're seeing the big divergence right here currently in a very, very steep. That's a sharp divergence, and really you can look at it. We've been diverging since this point back here, but this is the current most recent divergence, and it's a pretty big one. And again, anything is possible, but these things usually don't end well. So make no mistake about it. I say this often, but it bears repeating, because every now and then I get the, people that aren't listening or are new to the site. Divergences are not sell signals or buy signals if they're bullish divergence. Like I said, the big part of that beyond meat trade, was a positive divergence here on the daily chart as well as the 60-minute chart of BYND. Another stock today I did an update on, some of the lithium stocks I highlighted. Just what was this? Screenshot on December 16th, so just a few weeks ago. Highlighted this one as a breakout here with these price targets here, LIACF, it's American Lithium, and then today I followed up that we've already hit that second target there for 173% gain. So what's the takeaway from it? Well, simple things. These divergences, they work. Here's positive divergence, but again, the divergence wasn't a buy signal. We had divergence there, we had it here. Finally, boom, buy signal was a breakout and a back test of that trend line. That was probably about a 30% rally. We had it again here. We had positive divergence on LACF right there, divergent low, breakout and a nice rally again. Probably, well, I can measure it out for you. Let's grab that chart, do that, and then we'll wrap the video up. LIACF. That was need to turn off those lines so I don't move it. From that divergent low up to there, it was about a 67% rally, and so far from the most recent divergent low, about 272% rally. So we're able to catch most of that. There's your breakout right there, and I said it had to clear that 9.5 or so level. Broke out of the trend line, hit resistance a couple times, back tested the trend line, giving you another objective entry and a second buy point again once that was taken out impulsively right there, and it never looked back. So up about like I said, 100 and something percent there. So these positive divergences are just like the bullish divergences in reverse, but again, you can continue to diverge. You can have divergence here, you had it here, you had it there, finally, and you can see something a little bit different. You had that washout type candle. I wouldn't call that a selling climax. There wasn't enough volume. Sometimes you'll get that. These are things we'll be looking for in the stock market in reverse. Bearish candlestick reversal patterns, potential buying climax, which you'll see is usually you get a pretty good surge in volume with a pretty sharp spike up, finals after an extended run, things like that. All right, let's wrap it up here. And again, just to go back to the charts, not anything right now. Nothing has changed technically on the 60-minute charts or the daily or the weeklies for that matter. Here's SPY. You'll watch we have these little wedges forming here. These broke down last week, or a couple weeks ago I should say, but really didn't. We corrected in time. See, we had that sideways consolidation in SPY. So that would be the next thing. And if we break down, how does it look too? Do we just limp on through there, not very impulsively? Did we break down in SPY but not QQQ, because you want to see QQQ confirm as well? Those are the things I'll be looking for. Until then, more of the same. If we see this again tomorrow, I may skip the end of the day video. But like I said, I'll try to make a point to do a little more value added by going over trades. And I also want to make a point not to just highlight the successful trades, because there are plenty of losers in there. But as I tried to show you today, starting out with that BYND trade, you keep the losers small, let your winners run, or use attractive risk reward ratios, and you don't have to bat 1,000. You don't even have to bat 500, meaning you can get less than 50% of your trades right, be stopped out on more than that, as long as you're not risking a dollar to make a dollar. If you're risking a dollar to make a dollar, meaning you have a dollar stop loss on the downside and a dollar profit target on the upside, you better do better than 50% or you're going to be spinning your wheels. That's pretty much it. All right, guys, let's wrap it up here, and we'll pick this up tomorrow if there's anything that stands out. And subscribers, I will follow up tomorrow. There's a couple sectors that I'm watching, and I probably might do some videos in the morning for you there, put out some charts and a couple of new things that stand out. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.